our regular class together. So did I get everybody's homework number one? I will get these back to you, and we will talk about them on Monday. So one of the things I'm going to send you later today is homework number 2, right? And so that will be something that you can work on over the weekend. We're going to have this kind of quantitative literacy project that we're going to work on in this class, where I'm going to ask you to collect some financial data and do a little bit of analysis on it. And so the first homework number 2 is really beginning that process, right, of thinking about a financial topic or financial data that you might be interested in exploring, collecting the data, describing it a little bit, right? So I think it's pretty straightforward. It's kind of some Stats 201 stuff, very simple, straightforward Stats 201 stuff. And so, like I said, I'll send that in my daily to-do list. And then if you have any questions about that, you can contact me over the weekend. It's not due till Wednesday. Okay, so there's some time. So you have some time to do it this weekend. You have some time on Monday and Tuesday to ask questions. And so there's that. The other thing to think about this weekend is remember that your first exam is on Tuesday. Okay, and so we will talk more about the first exam on Monday, and we'll have a little bit of time to review for that exam, right? So you might want to begin, if you haven't already, begin studying, maybe collect some questions or some things that you're feeling in any way, shape, or form uncertain about, and we'll definitely have some time to talk about that. But yeah, the exam on Tuesday, will be in person Tuesday morning, right? It'll be in person Tuesday morning. So, all right. Any other questions about anything else before we get started? So today, we're going to talk about the stock market, right? Which is usually a pretty, interesting topic. I mean, we can't help but be somewhat interested in the stock market because we're constantly inundated with information about the stock market, including somehow this idea that the stock market is a perfect representation of how well the economy is doing, which is, I'm going to try to convince you of that that's not necessarily the case. But having said that, there is no doubt that the stock market is important. All right. Hold on one second. Okay. So stocks, right? Stocks, or sometimes people refer to them as shares or equity. They are financial instruments that allow corporations and people the ability to diversify risk, to transfer risk, to diversify their wealth, to earn higher returns, and to trade money for long, basically infinite periods of time, right? And that is one of the big differences between a stock and a bond, is that when you lend money in terms of a stock, you are potentially lending money infinitely, right? There is no maturity on most stocks, assuming the company doesn't go default, right? So stocks really followed the invention of a number of things within modern economies. First off, we needed the invention of money and finance, right? Stocks are a form of finance, right? And finance is a form of trading money. So we never had stocks until we really had the ability to have things that were generally accepted in trade and for money to be traded across time. Stocks also followed the invention of bonds. So bonds came before stocks, and we'll kind of maybe talk about why that is. But one of the biggest reasons why bonds came before stocks is that bonds came before corporations, right? And the corporation is fundamental to understanding what a stock is, right? What is a corporation? No, it's not a collection of businesses. What is a corporation? Oh, the holes in the things that we don't know. What's a corporation? A corporation is a legal person, It is a legal entity, right? It is a legal person that is separate from the owners of the business. So a corporation is a legal entity that can have many owners that change over time. And you can see why this was crucial to the development of stocks, because before corporations, all firms were owned by individuals, right? So the firm was tied to specific individuals. What happened if those individuals died? The firm would disappear, right? Or the person would have to sell the business to another individual, right? So the firm was linked to specific individuals. Corporations basically break this link. They break the link between ownership and existence. So corporations can enter into contracts, corporations pay taxes, corporations have many legal rights, but they're separate from individuals, right? So the owners of the company can change over time. Of course, this has a number of advantages. First off, corporations can live forever, right? Where individuals can't. This also makes ownership transfer very easy, right? Some of you might have parents who have small businesses or family businesses. One of the big problems with family businesses is what happens when the head of the business retires or dies, right? How exactly do you transfer ownership, right? That becomes a really important question in the survivorship of a business that is not a corporation. And then, of course, the other thing that the corporation provides is limited liability. The owners of the corporation are not responsible, legally responsible, for the things that the corporation does, right? So you could lose your investment in the corporation, but you cannot, in most cases, you cannot be sued for what the corporation does, all right? And that is a huge advantage. One other thing that stock provides is ownership in small denominations, right? Ownership in small denominations. So in a usual small business, it's hard to have more than one or two partners, right? I mean, most people are not going to invest in a small business to the extent of $1,000 or $2,000, right? Because it's just very difficult to do that. Having stocks and equity in a corporation allows you to have very small ownership. Most stocks in the US are what we call, or most corporations in the US are what we call Delaware corporations. Why? Because they're actually licensed or registered in Delaware. Why Delaware? Anybody know? Exactly. These are where the corporate laws are the most favorable to corporations, right? And so in terms of things like shareholders' rights, they're quite limited. And so one thing that differs American corporations from, for instance, many European corporations is most shareholders' rights in the US are pretty limited. I mean, you have to have a big chunk of stock to really be able to influence what a corporation does in the United States. In other countries, you can have just a little bit of stock and you can do things like put items of action on the corporate agenda, or you can get more information about what the corporation is doing. But boy, in the United States, right, those boards have pretty much carte blanche, right? Until you get to have a very big percentage of ownership, you have pretty limited rights, right? You have pretty limited rights in terms of finding out what the company's doing or influencing the decisions the company makes or making the company pay dividends, right? That's one thing that you don't really have much right of in the United States is if you're a shareholder, you can't make your company pay dividends for the most part. Okay, what's the trade-off between a stock and a bond? when a firm thinks about, well, am I going to raise money in a stock or in a bond? What are they thinking about? What's the pro and the cons?
When it comes to stocks, one of the pros is that if the company loses money, the stockholders bear some of the brunt too, and then the stock goes down. But the stockholders also share the benefit of makes money as opposed to paying back.
Right. So that's yeah, that's in terms of the person who buys a stock. But I'm kind of thinking from a firm, right? Firms can raise money in multiple ways. What are the advantages to the firm of issuing equity as opposed to maybe issuing a bond or going to a bank? Right. There are no fixed payments, and that gives you a lot of flexibility. What else do you not have to do? Pay back the principal. Right? That money is yours forever, essentially, unless you would buy back the stock. So in some ways, you get a lot more flexibility, right? You get a lot more flexibility. Of course, what's the cons?
You're giving it part of the interest.
Right. You're giving up the ownership. Well, at least partially, right? You're giving up ownership. And to some extent, control. And then there's I think how would you say it, the deeper question. What was I going to say? Shoot, I just had a senior moment. What was I going to say? Yeah, well, I don't remember exactly what I was going to say, but another con is that this is more expensive. Because holding a stock is riskier than holding a bond, what's going to be true about the market? It's going to demand a higher return. It's going to demand a higher return. So in general, this is an expensive way for firms to raise money. You're going to have to pay higher returns. But these are the issues that companies grapple with, right? These are the issues that companies grapple with. When you are a new firm, you know, we might add up here to the pros that this might be easier than issuing a bond. For many firms, their only option is to issue stock, right? Many firms simply, particularly new firms, simply aren't developed enough to be able to sell their bonds on the bond market, right? The bond market is really more for established firms. And so for new firms, young firms, selling equity is probably your only real option. That or going to a bank, right? Going to a bank. But banks aren't cheap either, and banks may not lend you money. And so, you know, your only option might be to go to the stock market. And so these are the questions. I'm not going to talk much about it because you all read this article, but I think hopefully you saw kind of these questions embedded in that article I sent you about should college graduates pay for college by issuing equity instead of borrowing, right? And there's actually an argument for that, right? That in some sense, you know, maybe it'd be easier for college students to raise money for their college if they actually sold equity, right? In other words, they sold a percentage of their future earnings. And while that sounds weird to us because it just is not, it's very rarely done, firms do this all the time, right? Corporations do this all the time. So if corporations can do it, why can't individuals? There's really no reason, right? Well, there might be some reasons, but there's no theoretical reason why it can't be done. In fact, that article talked about Yale in the 1970s did this, right? That they basically took 4% of someone's annual income for every $1,000 borrowed. Now that was $1,000 in 1970, which is a lot more than $1,000 would get you today. But yeah, right? And if you think about what would be the advantage to a college student of this?
It kind of reduces risk on the part of the college student because 4%, depending on your income, even though you don't know what your income is, 4% off the top is more.
Right. It's the same for a firm, right? From a firm's perspective, there's no fixed payments. I don't ever have to pay back the principal, and it might be easier for me to do that. Why do students seem to be reluctant? And many of you in your writings, I could tell, this would be a hard thing for you to think about doing.
For one, me reading the article, just the idea of owning equity in person as opposed to business entity, it kind of strikes me weird because real ownership of a human being is not something we will pay for.
Yeah, but of course we do this all the time, right? You know, if you have debts, what's the bank? If you borrow money from a bank, well, listen, if you borrow money for your college debt, trust me, you are an indentured servant to that college debt, right? They're going to be coming and knocking on your door and saying, "Give me money." I agree with you. There's something. The fact that they own your future income, I think there is something about that like is triggering. I'm not sure exactly why when you think about it more, but I agree with you that it is. One potential problem with this that many people have talked about, and many of you mentioned in your summaries, is the problem of moral hazard, right? That if I sell off a bunch of my future income, well, then maybe I'm not going to work as hard in the future, right? Or maybe I'll take that job in social work, right? Possibly, right? I'm not 100% sure that that's true, right? I really am not 100% sure if that's true. In part because, listen, people pay taxes too, and there's not a lot of evidence that taxes significantly impact the kind of jobs that people take. I've never heard anybody say, boy, I'm not going to take that job on Wall Street because I'm going to pay a lot of taxes. So I'm just going to sit here and be a school teacher. I don't hear that thinking amongst a lot of people. And so I'm not so sure that the fact that you owed a percentage of your future income to pay for your college changes people's incentive that much to really get them to think about different careers. But, it is an idea, right? It is an idea. Stocks are really sold in two different ways. In the primary markets and the secondary markets, right? Same as bonds. Primary markets is underwriting through investment banks, right? So when you talk about an IPO, you might have heard of an IPO, an initial public offering. That is essentially the primary market. And then you have secondary markets. And there's a lot of different types of secondary markets. Some of these are centralized exchanges, and we talked about this on the first day of class. A centralized exchange is a physical location. So, for instance, NASDAQ and the New York Stock Exchange. If you go to New York, you can actually visit these things because there's a physical location there. And then there's other markets that are over the counter. And over the counter means there is no physical location, it's just a network of dealers and brokers. Right? What's the advantage of having a physical location? Is there any advantage? Well, I'll tell you the trend is away from physical locations, right? Listen, the advantage of having a physical location is when you have a physical location, usually you have checks on trades. So usually trades have to go through more processes. That's a cost because it's costly to do that, but there's often more safeguards built in. There's a story of about a Japanese stock trader who made a typo on his keyboard, and instead it cost his company $340 million, right? Because what happened was, instead of selling 600,000 shares at 1 cent, he sold 1 share at 600,000 yen, right? Yeah, right? So those kind of mistakes can often happen in over the counter, as opposed to when you have through the New York Stock Exchange and NASDAQ, there's kind of more protection in trade. But then there's problems with the physical location, right? For those of you who are really into stocks, there's a couple of great books that have been written about the scam that took place here in recent memory, related to extremely quick trading, right? So some of the new information technologies have allowed basically companies to trade in billionths of a second. And so what some people figured out was the closer you could get to New York Stock Exchange, the faster your trade would go through. And if you could get close enough, you could actually get in there, see what another trade was coming, trade in front of it, and make a profit on it, right? Now that's not an efficient market, right? That's scamming the system. And for a long time, many investment institutions were essentially scamming the system by being able to buy, right, locations literally right next door to the New York Stock Exchange, because, you know, that would give them, you know, 1 billionth of a second advantage in making a trade. And so, as you know from your other readings, right, with all this electronic trading now by computers, many of these trades are just taking so fast, much faster than we as humans can really understand. But there's a big value in being able to do that. And so that's a case where having a physical location actually was not a good thing, right? Because some people were essentially trading on the ability to do that, right? And taking advantage of other people. Most of us follow stocks through stock indices, all right? And what's a stock indice? It's just a bundle of stocks in which you look at how the price changes over time. Most of us are familiar with the Dow Jones Industrial Index. It's probably the worst index you could possibly come up with, right? The Dow Jones is the 30 largest companies in the United States. It's only 30 companies, right? It's not a broad enough index to really tell you much about what's going on in the country. Interestingly enough, there's only one company that has remained in the Dow Jones since it was first started in 1885. You probably wouldn't guess, would you? Probably not. General Electric. General Electric's the only company that was one of the largest 30 in 1885 and remains the largest one today, or the largest 30 today. Other indices that are closely followed, the Standard & Poor 500, which is much better, right? The Standard & Poor 500 takes about 85% of the value of the US stock market. Okay, so that gives you some idea about the dramatic differences in sizes of firms, right? That 500 companies basically are 80% of the, 85% of the market. There's NASDAQ. NASDAQ tends to be more technology-intensive shares. There's the Wilshire 5000, which, despite its name, has about 6,500 companies in it. That's probably the broadest one, the broadest index that is generally followed. And then you can go out, and if you look across countries, there's all sorts of different indices that are looking at stock exchanges in China, in Europe, right, South America, right? But really, all these indices are, as I said, they're just bundles of stock, right? They're groups of stock, and you follow what happens to the price of that bundle of stock over time. Can you make money in the stock market? Yes. The stock market is probably the most reliable form of wealth creation in human history, particularly the US stock market. Just to give you some idea of this, since 1950, the S&P 500 has averaged about 10% real growth a year, meaning adjusted for inflation, 10% real growth. So how does that play out? Well, 10% real growth, if you know the rule of 72, right? Remember this from principles, right? If something is growing at X% a year, it doubles in size every 72 divided by X years. So if the stock market is growing on average 10% a year, how often does it double in size? 72 divided by 10, or about every 7 years. So think about that. You double your wealth every 7 years. That's incredible, right? That's incredible. And that's why there's so many millionaires in the United States when they retire, right? Is that if you can put your money in the stock market early, and this will be a theme that I talk about a lot today, but you know, the best way to become rich is to save early and to leave it there, right? That is the ultimate key to getting rich in the stock market, right? Is to take advantage of the power of compounding. Just to give you some idea, government bonds have only averaged about 2.5% real return. So equity has been a much, much better bet. Of course, what's the downside? You could. I would say that for most people that you're kind of an idiot if you do that. But what's the other big risk in general to just like putting your money in the S&P 500? Sure, it's going to give you 10% on average. But what's it going to give you any specific year? Who knows, right? Who knows? There's a lot of risk year to year, right? I mean, just look at what happened this year, right? In March and April, the stock market went down by about 25%. And then this summer, the market went up by about 25%, okay? You know, in 2008, we saw the stock market fall by 40%. In 1987, the stock market fell by 22% in one day, okay? So there's a lot of risk, particularly day to day, right? If you have a short horizon, meaning you can put your money in the market, but you're going to have to pull it out soon, you are exposing yourself to a lot of risk, right? You are exposing yourself to a lot of risk. And so that, of course, is the balance that every investor's got to think about here is risk and return, right? The stock market does great on return, but the risk is not insignificant, right? The risk is not insignificant. Why is valuing? Let's talk a little bit about valuing the stock. Okay, we'll begin like we did with bonds by kind of talking about the micro stuff, and then we'll kind of back up to the big picture. Valuing a stock is more difficult than valuing a bond because there's more uncertainty. Right? There's a lot more uncertainty. What don't you know when it comes to a stock? Well, what do you know with a bond? What? You know, right. So, right? There's no maturity that gets paid back. There's no coupon rate. Right? You're not guaranteed any future profits. you don't know for sure what those future profits are. And then you really don't know what the risk of a stock is for the most part, right? You don't know about default risk. You don't know about macroeconomic risk. That we could go through a recession or an expansion that could hurt the firm. So there's a lot that we don't know, but if you did know these things, calculating the price of a stock is really just, we can take the tools that we learned in pricing a bond and apply them directly to pricing a stock, right? So let's think about how we would calculate the price of a stock. All right, calculating the price of a stock. Well, let's first begin by thinking about what would be the one-year return on holding a stock. So in other words, you have a stock, you're going to buy it, and you're going to sell it 1 year from now, right? What would the price be? Well, when we calculated bonds and the yield to maturity, what did we do? We set the current price equal to the present value of future payments. That same principle can be applied to stocks, right? What should be true about the current price? We'll call that price at time 0. It should be the present value of future payments. So what's your future payment? Well, what do you get over this next year? Possibly a dividend. But we have to discount this back, right? And here I'm going to use K. Instead of the interest rate, I'm going to use K, and I'll explain why in a moment. And then what else do I get? At the end of the year, I sell the stock, right? So at the end of the year, I get the new price. I get the new price. So this is the price at the end of the year. This is the price at which I buy it. That's the dividend that I may or may not get. And what's KE? KE is the required rate of return. This is basically based on your trade-off between risk and return, right? It's going to be based on what you think the risk of the stock is. So if I told you that the expected dividend is going to be $2, the price is going to be $100, your required rate of return is 16%, you could tell me what price you'd be willing to pay for that, right? You could tell me what price you'd be willing to pay for that. We can take this then and kind of generalize it into an N-year return. How's the N-year return going to look different? Well, we just have more dividend payments, right? So it's going to look very similar. Except we have to discount all of these dividends back. So once again, I hope that the intuition here is pretty straightforward. How much should you pay for a stock today? The present value of future payments. That's how much you should pay for a stock. You could kind of think about this as, oftentimes people refer to them as fundamental investors, right? Fundamental investors means they actually try to go out and they try to figure out how much money the firm's going to make. And then they calculate what you should pay for that, right? What you should pay for that. However, there's a couple of problems with doing this in the real world. And the problems relate to, we don't know all of this stuff. For instance, we don't know what the price is going to be end periods from now. That is highly uncertain. And then we don't know what future dividends are. So that's a problem, right? Because those would be two very nice things to know. However, there is one way, one approach that we can try to get around these problems, right? And that's what's called the Gordon growth model. Which is a common, I'll call it a rule of thumb in financial markets. The Gordon growth model makes two assumptions. First off, you hold the bond, or I'm sorry, you hold the stock forever. So then what becomes that part of the equation? It drops down to 0. Right? If n is large enough, this just becomes 0, and you can ignore it. So this assumes that you hold the stock forever. Is that a good assumption for most people? Of course not. But it's a simplifying assumption, right? To help us get a rule of thumb. And second, you have to make an assumption at what rate the dividends grow. And we call that G, right? Dividends grow at the constant rate G. With these two assumptions, if you use a little bit of math, which we won't go through, but it's not particularly complicated math, what you can show is that it becomes then pretty simple. To calculate what the price is. So remember, these are two limiting assumptions, right? This is not really very good. These are probably not a description of the world for most people, right? Not for most people. But you can use it as a rule of thumb, right? So once again, not as something exact, but as something to kind of give you a ballpark idea of what a stock should be selling at. So the nice thing about this is we know what the last dividend was, and we know what the price is today. I'm sorry, we know what the last dividend was. If we know what our required rate of return is, and if we can make a guess about how fast dividends will grow, we can figure out what the price is. Right? So this is easier to calculate than this, definitely. But you have to make some big assumptions. And these assumptions may or may not be accurate about the world, right? So where does, well, actually, let's just do a very simple example of this. Okay, let's say that there's a stock, its last dividend was $2. You think, based on a risk, that you need a 10% required return on this. And you think that the growth rate will be 6% in dividends every year. What price, under the assumptions of the Gordon growth model, right? So remember, this is some pretty limiting assumptions, but under the assumptions of the Gordon growth model, what price should you be willing to pay? $2 times 1 plus 1.06. Oh, sorry. Hit the wrong one. No, I didn't. I was looking at this funny. Right? And then KE is 0.1. Anybody got a calculator? Just made up this example, so I don't know what you want to go. $53. Sounds right. That should be the price you pay for it. So for a stock, what makes a market? Oh, go ahead, Liz.
Sorry, I have a question about the first assumption.
Yeah.
Is it supposed to be the price over 1 plus P, or is it supposed to be dividend?
Oh, yeah, you're right. Not dividend. KE, thank you. Right. So what makes a market? Well, what makes a market is disagreement. Right? What makes a market is some people are willing to buy and some people are willing to sell, most likely because they disagree upon what it's worth, right? And so when you think about this equation, you can kind of see where there's often disagreement among people. And it's these disagreements that creates a market of buyers and sellers. One disagreement is different required rates of return. Different investors have different risk and return preferences. When you guys get a job, and you open a 401k account, right, where you start to save for retirement. The first thing that happens when you open that account, whether you're talking to an investment advisor in person or whether you're just doing it online, which increasingly you can do this online, the first thing they're going to ask you is they're going to ask you some questions about your preferences for risk, right? Are you a nervous person? Does it make you freaked out if you see the stock market go up and down, right? When are you thinking about retiring? Are you thinking about retiring in 5 years? Are you thinking about retiring in 50 years, right? These are all trying to get at your different required rates of return, right? So different people are going to have different required rates of return. Also, it depends what your portfolio looks like, right? In your portfolio, one stock could be very risky, but in another portfolio, it could actually be adding to the safety, right? Depending upon what your diversification strategy is. Investors have different G, right? Basically, investors differ about the growth potential. Some investors might think that the company is a great bet. Other investors might think that the company is not such a great bet. And then finally, it's not in here, but it was in our other equation. Different investors have different investment horizons. For some of them, it might be saving the money for retirement. And that retirement might be 50 years from now. Okay, that's going to significantly impact your return on it, your required return on the stock and what you'd be willing to pay for it today. But if you're saving for a down payment on a house, maybe not, right? Maybe not. So the nice thing about the Gordon growth model, and listen, I don't think anybody, but I should say never, but you're not a very well-informed investor is if you go out and you start to buy stocks based on whether their price is greater or less than the Gordon growth model, right? The Gordon growth model is not, I think, the end-all be-all in how you price stocks, right? It's just not. But it's useful. It gives you a rule of thumb, right? It gives you a rule of thumb, and it gives you a way of thinking about how stocks get priced in the market, right? And so we can see the nice thing about the Gordon growth model is it very clearly lays out these three things that are really important. Let's talk about how monetary policy impacts the stock market. Yesterday, we talked about how monetary policy impacts the bond market. Today, we need to talk about how monetary policy impacts the stock market. And really, there's a couple of different ways, right? A couple of different ways. First off, as we talked about yesterday, changes in the money supply tend to change interest rates. And interest rates impact the stock market. What happens if the Fed raises the money supply and cuts interest rates? What impact is that likely to have over here on our Gordon growth model? Where do interest rates show up? They're not in here directly, but where are interest rates most likely going to impact? my required rate of return, right? If interest rates on bonds go down, what happens to my required rate of return on stocks? They go down as well, right? Because we have to always think about relative return. So if there's lower returns in the bond market, I'm most likely going to be willing to accept slightly lower returns in the stock market. And when required return goes down, what tends to happen to stock prices? They go up. So when the Fed cuts interest rates and raises the money supply, that usually fuels an increase in stock prices. We also know, or hopefully you remember from principles, that these changes in the money supply likely impact output, right? GDP. And that usually means more profits. And more profits are going to do what to stock prices? Drive up G and lead to higher stock prices. So it's usually through two things, right? Impacting required return and impacting growth that we think about monetary policy influencing stock prices. Does monetary policy have a big impact on stock prices? I would say yes, right? I would say yes, in part because markets to some extent have come to expect central banks to bail them out. Not directly bail them out, but bail them out in terms of providing for lower interest rates and trying to stimulate profits during bad times, right? So you might actually say that a third channel here is that markets really expect the Fed to reduce overall risk through stabilization policy. Which also reduces KE. Okay. So there's no doubt that markets believe that monetary policy is an important player in what goes on in stock markets. And so usually if the Fed is trying to stimulate the economy, they're also stimulating the stock market, right, and vice versa. Okay, let's now kind of switch gears a little bit and talk about, investment strategies, right? Now let's think about this. Let's think about this from the perspective of individuals who are thinking about getting in the stock market. The key to understanding how stock markets work and the key to understanding investment is to understand the nature of uncertainty and risk. How do people form expectations in a world of uncertainty? How How do people form expectations in a world of uncertainty? Well, traditionally, economists have one view of this, and we can call that view rational expectations. Right? This would, I guess we could call this the traditional economic view of how people form expectations in a world of uncertainty. And what this means is that people use all available information people use all available information and do not make predictable errors. Okay, so one of the misunderstandings about rational expectations, and I think economics in general, is many people have this idea of, well, economists think that nobody ever makes mistakes, that people are just like these perfectly omnipotent beings that never screw things up. That is not at all what economists think, right? But the key is, economists don't think people make predictable errors. Why? Because they use all available information. Now, sometimes information is not available. And as a result, you will make mistakes. But the key to understanding these mistakes is the mistakes are random errors, right? They're not predictable errors. They are random errors. So random error is possible. But predictable error is not. It should not if people are rational. So, for instance, economists assume that most people drive their car by looking out the front window. Okay, that would be an example of a rational behavior. You look ahead and you use your eyes and all available information in steering the car. What would be irrational behavior? Looking out the back window. Will that work? Sometimes it could work. If the road is straight, you might be okay. But the problem with looking to the past only is that if the road curves, you're going to go right over it, right? And so all available information means not just looking to the past, but also looking to the future. Right? Not just looking to the past, but looking to the future. If people are rational, then that has some pretty strong implications for how stock markets should work. Okay. That has some pretty important implications. First off, when should prices move? Prices only move when there is new information. Only new information moves prices. Okay? Example, the Federal Reserve announces that they're cutting interest rates and the stock market doesn't change. What does that tell you? I'm sorry? Exactly. The market already expected it. There was no new information there. The Fed did exactly what they thought. We've seen phenomena like this where, what was it? I think it was last quarter or the quarter before. Amazon announced a record profit and the share price dropped. How do we explain that? What was the new information? Bad. In other words, the market was expecting an even bigger profit, right? So it's not information, sometimes you hear information drives stock prices. No, not all information, new information. It's only new information that leads to changes in prices, right? It's only new information. Second, here. Errors are going to be unpredictable and random. And this one, maybe you can see where we're going. What happens if you beat the market? What's the chance that you're going to beat the market next year? 50-50, right? That economists believe that if markets are rational, that beating the market is truly a random outcome. That at any point in time, some people are going to beat the market, some people are going to do worse than the market. But on average, those errors are going to be random. There's no way to consistently beat the market. And as we're going to talk about in a couple of minutes, this is so hard for people to understand. There is so much resistance to this idea. We want to believe that there are people out there beating the market. We want to believe that we can beat the market, right? Every morning I get so upset, not to do my own griping and complaining, but I have this little tradition of I listen to sports radio when I drive up here. It's just, whatever. And I'm getting increasingly mad because all sports radio is talking about betting, right? What's the spread? Which team I'm going to bet on? It's all about betting. And it makes me mad because obviously there's a lot of people here who think that they're smarter than the market. Basically, everybody in America now thinks that they're smarter than sports investors, right? I tell you what, you're not, right? These sports investors have millions and millions of people working for them, computers, all this kind of stuff, right? Can you beat the market on some weeks? Sure, but it's random. It's random, right? And chances are, in the end, you lose to the house, right? We all know this from casinos in Las Vegas, right? In the end, who always wins? The house. Right? Because winning and losing is largely a random proposition. Why? Because you can't be smarter than the market. There's only one way that you're going to be smarter than the market. And that is if you have better information. But of course, if you have better information than the market, what are you doing? You're insider trading, and that's illegal, right? So unless you're trading on illegal information, you can't be smarter than the market, right? The market has vast number of people scanning each and every day, looking for even the smallest opportunities to make a profit, right? And they have information, the market's ability to process all information is much greater than your ability to process all information. And so what usually happens when people think that they're smarter than the market? They buy high and sell low, right? And this is the typical, right? The typical thing is, in March, because people know I'm an economist, everybody's always like telling me, what should I be doing in the market? And so, in March, when the market is tanking, what do I hear from all my friends? Oh man, the market is tanking. I should be getting out. No, you missed it. The market's down, right? You get out now, you've lost the money, right? That's the time to buy, right? Honestly, the smart investors buy then. Now, of course, for most investors, you can't do that because you don't have the liquidity to do that, right? And so that is one advantage that some investors have over others. It is easier for Warren Buffett to be a rational investor. And Warren Buffett very clearly has a strategy. And the strategy is when markets go down, I buy more. When markets go up, I sell, right? But he's got an ability to do that because first he's got, teams of people working for him. But second, he's got all the liquidity in the world, right? If you don't have billions of dollars at your disposal, it's a lot harder for you to do that. And so if you take these three implications together, this has a pretty clear message for what the best investment strategy is. Right? The best investment strategy is to recognize what economists call the efficient market hypothesis. No one can consistently beat the market. Prices follow what economists call a random walk. They are unpredictable. Now, I don't mean completely unpredictable, right? We know the stock prices are going to go up, right? If the market goes up by 5% every year or 10%, then all prices are going to go up. But let's think about the price of one stock. Will it go up by more than 10% or less than 10%? It's random. It's random. Some years it will go up by more, other years less. And so, what's the strategy? In this world, how do you take advantage of the market? What's the best play? Passive. Just follow the market. You buy and hold. Right? There's a couple of big advantages to this. First off, you don't end up you don't screw up your timing, right? Which is what most people do. When the market goes down, they sell, and when the market goes up, they buy. So they're buying high and they're selling low, and their timing is screwing them up. You shouldn't be trying to do that. Don't time the market, right? Because most people screw it up. The other thing about this that's really good is that you keep your costs low. And this is a real thing, right? Most mutual funds, to give you an idea, most mutual funds that are actively managed, the costs are between 0.5% and 3% a year. You lose that money that is return that disappears because it goes to the managers of the fund. What about a passive index fund? Right? An index fund is just a fund that follows an index, right? Like the S&P 500 or the Wilshire 5000. It's just going to follow that. And when the stock market goes up, your fund will go up in the exact same portion. These passive index funds, usually the costs are 0.1%. There's your profit. Because if you compound that over years, you begin to really make some money, right? Over a 50-year investment period, right? Over a 50-year investment period, which is what most people have to save for retirement, you could have 50% more money by saving transaction costs in this way. 50% more money, right? It doesn't seem like a lot, but when you compound it over time, it really adds up, right? And so, yeah, a passive investment strategy, buy and hold. Related to this, the other part is you should get an index fund. What's the value of an index fund? It's just diversified. This is, I'm sure, something that you've talked about for those of you who've had other finance courses. Talk about the difference between idiosyncratic risk and systematic risk. Yes, yes. Anybody remember what the difference between these are?
Idiosyncratic risk, diversified. Reduce it with diversity.
Right. So idiosyncratic is tied to a specific company. Such as default risk would be an example of idiosyncratic risk, or the fact that an industry comes on hard times. Where systematic risk is the entire market. The risk associated with the entire market, such as a recession, going up or down. So what does diversification allow you to do? Get rid of this, or not get rid of it, but reduce it to a very, very low level. Right? So what's the chance, what happens if a company gets a bad manager who goes rogue and blows $1 billion? That can happen, right? But you can reduce your exposure to those kind of risks by being diversified, not holding all your eggs in one basket, right? Which is that old wives' tale, but it's definitely true. Once again, I'm using gendered language here. Old man's tale. Yeah, I shouldn't say old wives' tale, but what are those old phrases, right? Don't put all your eggs in one basket. Well, that's true in finance, right? You've got to be diversified, right? You've got to be diversified. The final thing that makes sense for most people is you got to think about taxes, right? Many programs allow you to put money in pre-tax and only pay the tax when you pull your money out. That's huge, because what does that mean? You basically get to compound the money over a long period of time. The money that you pay in taxes, you actually get to compound, and you don't pay taxes to the end. So, right, why are things like 401k programs, or these are things that most of you don't have any money, so you're probably not that familiar with them. But these are ways of deferring your taxes. So basically you can put in a 401k, you can put money in before you pay tax on it and just leave it sit there. You can't pull it out, but you have to leave it sit there. But over years, that money compounds in value, and then you only pay your tax at the end when you pull it out, right? These are great strategies, right? So, and when you put your money in a 401k, this can then go into an index mutual fund, right? So most companies have all sorts of different options for how exactly you invest this 401k, but all companies nowadays you have some options that are related to index mutual funds. The last thing is ignore the professionals. Ignore professionals. Everybody is telling you that they're beating the market. Maybe I'll save this for a second, but I'm going to tell you that there's very little evidence that there are people out there who consistently beat the market, right? So yeah, professionals want to give you hot tips and things like that. The thing is, once it becomes a hot tip and you're hearing about it, other people have heard about it, right? And if it's new information, it's already reflected in market prices, right? Chances are you're not faster than a computer. And so, particularly in this day and age when everything is becoming computerized, it is very, very difficult to consistently beat the market. Why is it so hard for people to follow these three strategies? Today, it is true that 50% of money in stock markets is held in indexed funds. So that's a dramatic, economists have been preaching this for years. Today, half of all money is in index funds. The other question is, who the hell is that other 50%? Right? Who the hell is that other 50%? And all I can say is it's just a hard idea for people to understand, right? We just have this inclination to think that there's got to be people out there that are smarter, right? There's got to be people out there that are smarter. And so there's a lot of con artists, right? There's a lot of con artists. It's difficult to get a man to understand something when his salary depends on not understanding it. And I think that's often what it comes down to, that many financial advisors have a big incentive for you not to understand this, for you to think that there's like some sort of great insight. Listen, it is hard not to be skeptical about the investment industry in the United States, right? Only recently, meaning last year, has the Department of Labor required all investment advisors to behave according to fiduciary rules. What's a fiduciary rule? A fiduciary rule means the investment advisor is required to put their client's interests first and always act in the client's best interest. Not till 2019 were financial advisors required to do this. In other words, it was not the law that they had to act in the client's interest first. It's crazy. And now many economists are asking, how can any investment advisor be giving advice for people to buy individual stocks when we know that the best advice for most people is an index mutual fund? How can investment advisors be giving this advice? It's a legitimate question. It appears like that the ones who are doing this are violating fiduciary rules, right? So it's frustrating, right? It's frustrating. But for most people, this is the thing to do. Now, of course, people will always want to point to other things, right? To say, yeah, but, for instance, yeah, but what about Warren Buffett? Yeah, well, Warren Buffett's a really great example. Warren Buffett has done worse than the S&P 500 the last 10 years. Okay? So yeah, is Warren Buffett a multi-billionaire? Sure. When you start with $1 billion, it's a lot easier to get to 2 billion and 3 billion, right? And so Warren Buffett's company has not done great the last couple of years, right? you know, some of this is just random, right? That some people are going to be lucky for a few years in a row and get a nice nest egg and take off. I will say, though, there is one thing about Warren Buffett that provides him a distinct advantage, and that is he's got the kind of liquidity that he can get the highest returns, right? When you, I think Warren Buffett recently said he was sitting on $3 billion in cash. When you're sitting on $3 billion of cash, that gives you a lot of flexibility to kind of take advantage of you know, certain ideas that come along, right? And so Warren Buffett is not just the guy who just plays stocks, right? He actually invests in companies and revitalizes companies and things. And he's got a big advantage because he's got a lot of money, right? So I don't think the existence of Warren Buffett's prove that the stock market is somehow inefficient or that you can make money by yourself. Many financial advisors point to the fact that that their company has beat the market 3 years in a row, 4 years in a row. Well, why? I think there's a really good explanation for that. First off, that can still be consistent with random behavior, right? If you've ever flipped a coin 100 times, you're going to get 3 or 4 heads in a row, right? That's just how it works. But the other part of this you have to understand is what's called survival bias, right? 80% of mutual funds go out of business. Why? Because 90% of active managers do less well than the market. So 80% of mutual funds go out of business. But what are the ones that survive? Yeah, the lucky ones, right? The lucky ones. And so when you have this much churning, right, of funds going in and out of business, at any one time, a lot of the funds are going to have beaten the market from multiple years in a row, but that's just luck, right? The ones that haven't beat the market go out of business and replaced with new ones, right? And so, yeah, anytime you look at the market, you'll see all these funds that say they consistently beat the market. Well, you know, that's because of survival bias. So basically, since 1970, there have only been 2 of 281 funds that have outperformed the market by 2% or more over that time. 2 out of 281, right? That's looking a lot like random behavior, right? A lot like random behavior, right? So I've got to show you this. This is something this idea you might have heard of before. But because we're in election season, there's all this talk about Donald Trump and, of course, whether he's a good businessman. Where can I find this? Okay. And so how do you address whether somebody's a good businessman? Well, being a good businessman means beating the market, right? It doesn't just mean being rich. Because the thing about being rich is that Donald Trump was born rich. He's given $10 million by his dad. So the question is, what would have happened if Donald Trump put that money in an S&P index fund? He'd be rich today, right? So the question is, did he do better than the market? And so this is actually, I'm sorry, the stuff up here is so hard to see, but you can see based on when he started in 1985, this is the S&P and this is the value of his holdings, right? So Donald Trump, it's hard, his finances are a real mess to kind of understand. But there's very little, I think the vast majority of the evidence suggests that he'd be a much, much richer individual if he just put his money in an S&P 500 index fund. And that's not just true for Donald Trump, that's true for almost everybody, right? Very, very difficult to consistently beat the market, right? It's very difficult. And so, yeah, you know, there's just not a lot of evidence that people do that. Related to the efficient market hypothesis, I'll just say very quickly, there's also a lot of evidence that only new information moves stock prices, right? So stock prices only move with new information, that stock prices do follow a random walk, meaning that their movements are unpredictable. And that a lot of technical analysis, like looking for trends or all this kind of stuff, looking for patterns or rules, doesn't consistently work. There are probably, I would say, a couple of questions about the efficient market hypothesis, and we'll just talk about these really briefly before we go. Are there, if you look at markets, are there anything out there that doesn't quite appear efficient, right? Or doesn't quite make sense based on rational expectations? And I will say there are a couple of things that are puzzles to people in finance and economics. And so these are things that are interesting, you know, for you to consider. First off, there does appear to be a bias towards or against small firms, right? In other words, relative to their risk, small firms provide higher returns than big firms. And that's a really interesting question of why that's the case. Some people have said, well, maybe it's because big firms have more information, and so small firms don't have as much information, so investors are reluctant to invest in them, and that's probably part of it. But there is this what's called small cap bias, small capitalization bias, that small firms do tend to do a little bit better in the market than big firms, strangely enough. The other thing that's worth considering, and this is what we'll talk about this afternoon, but the role of psychology in market overreaction, right? There's a lot of evidence to suggest that markets are quite rational and efficient in the long run, but in the short run, they can be inefficient and quite irrational. And so that's what we want to talk about this afternoon, right? Is why is that? And that's really going to get us into talking about psychology, right? The role of psychology in markets. And where people make predictable mistakes often in markets is usually in the short run, right? And usually not being as rational as they can be over the long run. So let's come back and finish up this afternoon. I don't really want to go much more than an hour. Hopefully we need to keep it a bit shorter than that. So we'll meet back here at 12:30 and definitely be done by 1:30, okay? Because, you know, I hate meeting on Friday afternoons. I hate it, but stupid COVID. All right. Thank you all. See you in a little bit.